Namaste. I'm Sanjay Chawla, Chief Investment Officer at Baroda BNP Paribas Asset Management Company. Today, we look into the perspective, the key events in this quarter, their impact on the markets, and what events to watch out in incoming period. Besides talking about our views on the equity market, today I will touch upon the current IPO boom and the developments in and around AI and how does it impact equity markets. Before we begin, let me share some fun facts with you. So, while the festive season of lights just ended on a bright note, another spending season is now ongoing. One that fires up significant chunk of the Indian economy, the wedding season. This year, an estimated 46 lakh weddings are projected to happen in India between November 1st and December 14th, which would add approximately 6.5 trillion to the economy. This is marginally lower than 48 lakh weddings last year, but higher than last year's contribution of 5.9 trillion Indian rupees. The national capital, Delhi, alone is expected to contribute 1.8 trillion from 4.8 lakh weddings. Just to put this into perspective, I would like to highlight the whole of India collected 1.8 trillion every month as GST, broadly the same amount that Delhi is expected to spend on weddings in just a few weeks. Now, back to the economy. If I take a step back and look at what stands out most is how balanced the Indian macro environment has remained in a year when the global conditions swung widely. The festive season ended with a firm consumption, and the GST cuts on the consumer durable and electronics provided a timely lift to discretionary demand. These elements, combined with a stable monsoon, reinforce that domestic activity continues to hold its ground. RBI's upgrade of India's FY26 GDP growth rate to 6.8% captures this resilience well. Consumption has held steady, private investment remains stable, although selectively the government spending continues to anchor the infrastructure growth. Inflation has been the biggest positive surprise. From the charts displayed on the screen, you would notice that the October CPI print came in at just 0.3 YOY, sharply undershooting expectation. With the repo rate at 5.5%, another cut seems likely in future. While liquidity has fluctuated due to forex operations, the broader stance remains supportive. RBI has multiple tools to manage short-term tightness, and the policy direction leans towards gradual accommodation. Globally, the policy cycle has turned more growth-friendly. The US Federal Reserve has cut rates by 50 basis points this year and ended quantitative tightening. The ECB has maintained policy rate with its inflation near target, and Japan is moving cautiously towards normalization. Across major economies, growth has held better than expected, supported by strong labor markets and healthier balance sheet. Geopolitically, the tone has shifted from crisis to cautious stability. The US has circulated a draft Ukraine peace framework, and the Israel-Hamas truce has helped calm energy markets. These developments have reduced extreme tail events that dominated the discussion early in the year. Back home, India enters 2026 with a relatively calm macro setup. Going forward, the coming 8th pay commission and the lagged impact of easing are likely to support consumption, particularly in autos, durables, broader discretionary categories. As the rate ease, we expect credit growth to stabilize and NIMs to bottom out, with the asset quality remaining resilient. In the financial market, over the last 3 months, as is also indicated and displayed by the graphics, auto and metals have done well, while FMCG, healthcare, and IT have remained laggards. For the Indian market, the defining feature continues to be domestic liquidity. While FIIs have withdrawn nearly $30 billion since late 2024, the domestic investors have added over $70 billion. SIPs continue to remain healthy and inch up steadily month after month. India has effectively internalized its liquidity cycle, and this structural shift is a core reason why global volatility has translated into opportunity rather than disruption. It is also why many strategists from global houses have upgraded India to overweight in recent times. India's fiscal and external fundamentals remain broadly contained. The trade deficit widened modestly on higher gold imports, and the state-level fiscal pressure remains a risk. These challenges are manageable. Earning growth remains steady, led by domestic cycle, while export-linked sectors continue to reflect global uncertainty. Now, let me talk about the IPO boom and its implication on the financial markets. Another indication of the domestic investors' resilience and confidence in the market is exhibited in the ongoing streams of IPOs. The scale of demand is huge, and the size of deals which are happening showcases investors' belief in the India's growth story. India has emerged as a global center for capital formation, with more than $52 billion being raised over the 5-year period. From the attached graphic, you can observe how IPO values have been growing. For calendar year 24, saw $19 billion raised across 91 companies. Calendar year 25 is on track to surpass that, supported by an exceptionally strong pipeline. This momentum is being driven by two structural forces. First, private equity and venture capital investors are entering their monetization cycle. With $347 billion invested over the 7-year period, many businesses are now approaching public market. Exiting these investments will recycle the same resources and will drive funding into the next wave of entrepreneurship. With the domestic investors accounting for roughly 75% of the IPO participation, the Indian capital markets are no longer dependent on global flows for market depth. These IPOs are reshaping market structures. New age technology and fintech firms are entering indices, shifting sector weights and influencing passive flows. A trajectory similar to China index evolution, where nearly 40% of the constituents are growth-oriented tech companies. But it is important to remember that listing does not guarantee long-term wealth creation. A look at the attached visual would indicate the returns across the recent IPOs have been uneven. Roughly half of the new age IPOs have not rewarded investors meaningfully. Discipline and not enthusiasm must guide allocation, and this is something that we have imbibed in our investment process. Finally, let me come to another very interesting topic which is making global headlines: AI. AI's progress is real and commercially meaningful. Companies across industries report productivity gains from automation, accelerating coding, and improved analytics. Data center demand is booming, and hyperscalers are expanding capacities at an unprecedented rate, while this artificial intelligence is having its impact on the real world, the financial market has also taken notice. The chart on display would indicate that globally, whether it is US, Taiwan, or Korea, index performance in the recent past has been led by AI-related plays. For the S&P 500, growth has been largely driven by top AI, tech, and semiconductor-related stocks such as Nvidia, AMD, Palantir, Alphabet, Oracle, Broadcom, Microsoft, and Meta. Together, these stocks constitute more than 25% of the index. For the Taiwanese benchmark index, TAIEX, growth has been driven largely by TSMC, which constitutes over 40% of the index and is also the world's largest semiconductor company, benefiting from the high demand for AI chips. Even for the Korean index, KOSPI, upmove has been largely driven by Samsung and SK Hynix, two players in the AI ecosystem. SK Hynix supplies high bandwidth memory chips to Nvidia for AI application and has also announced partnership with OpenAI to supply advanced memory chips. On one hand, while global indices have ridden the AI wave, on the other hand, Indian indices have been behind. The Indian IT sector's relationship with AI remains indirect for now, while we are executing early transformation projects, but monetization remains modest. Further, Indian IT companies are facing pressures due to spending shifts from services to hardware due to AI-led investments. An industry in India that has witnessed a sharp boom on the back of this AI wave is the data centers. As of April 2025, India's installed data center capacity stood at approximately 1,350 megawatts and is expected to scale up to over 5 gigawatts by FY30, implying more than 3 times increase in the 5 years. This growth has attracted substantial commitment from global and domestic hyperscalers like Google, TCS, Amazon Web Services, and Microsoft. Additionally, key players for the data centers, power infrastructure, and cooling system providers, which typically account for nearly 50% of the cost, are also expected to benefit from this. Overall, this opportunity translates into capex of Indian rupee 2 trillion cumulatively over the next 5 years, translating into one of the largest multi-year capex cycle in the country outside the renewable. Another important thing to note here is that while a lot of emerging market flows have moved to Korea and Taiwan due to the excitement around AI, Indian markets have been cushioned due to support from the domestic investors. If you look at the visual on the screen, you will notice that this has been showcased in the ownership pattern as well. As of September 2025, FPI, foreign portfolio investors' ownership in NSE listed companies has reduced to 16.9%, the lowest in over 15 years. But owing to the retail confidence in the Indian growth story, DII ownership has increased to 18.7%. If India's IPO boom reflects the strength of the domestic liquidity cycle, AI represents the global innovation cycle. Together, they form the backdrop against which we shape our positioning for 2026. Given the uncertain environment in the global context, we prefer domestic plays at the current point of time. Our top 3 overweight sectors are healthcare, essentially hospitals, industrials, and consumer discretionary. Our top underweight sectors are materials, consumer staples, and real estate. Within the healthcare space, we are positive on companies with a higher share of domestic business. In the consumer discretionary sector, our optimism stems from the healthy demand witnessed during the festive season, partly due to the recent GST rate cuts. Within the industrials, we are positive on the companies linked to power generation and power transmission. If India's IPO boom reflects the strength of the domestic liquidity cycle, AI represents the global innovation cycle. Together, they form the backdrop against which we shape our positioning for 2026. Given the uncertain environment in the global context, we prefer domestic plays at the current point of time. Our top three overweight sectors are healthcare, industrials, and consumer discretionary. Our top three underweight sectors are material, consumer staples, and real estate. Within the healthcare space, we are positive on companies with a higher share of domestic businesses. In the consumer discretionary sector, our optimism stems from the healthy demand witnessed during the festive season, partly due to the recent GST rate cuts. Within industrials, we are positive on companies linked to power generation and power transmission. As a house, compared to the previous month, we have reduced our cash levels. As we close out on 2025, what stands out most is how India has managed to preserve momentum in a world defined by uncertainties. Christmas reminds us that lights shine brightest when the backdrop is the darkest, and India's fundamentals have offered that light. The new year is often associated with resolutions. While markets may not make resolution, but they do offer lessons. And the lesson of 2025 is clear. Stay anchored in the fundamentals. Stay cautious when the narrative runs ahead of reality, and stay open to the possibilities that structural shifts can unlock. As we enter 2026, the task is not to predict every twist, but to position thoughtfully for cycles larger than any single quarter. Here's wishing you and your loved ones Happy New Year, Happy. If India's IPO boom reflects the strength of the domestic liquidity cycle, AI represents the global innovation cycle. Together, they form the backdrop against which we shape our positioning for 2026. Given the uncertain environment in the global context, we prefer domestic plays at the current point of time. Our top three overweight sectors are healthcare, industrials, and consumer discretionary. Our top three underweight sectors are material, consumer staples, and real estate. Within the healthcare space, we are positive on companies with a higher share of domestic businesses. In the consumer discretionary sector, our optimism stems from the healthy demand witnessed during the festive season, partly due to the recent GST rate cuts. Within industrials, we are positive on companies linked to power generation and power transmission. As a house, compared to the previous month, we have reduced our cash levels. As we close out on 2025, what stands out most is how India has managed to preserve momentum in a world defined by uncertainties. Christmas reminds us that lights shine brightest when the backdrop is the darkest, and India's fundamentals have offered that light. The new year is often associated with resolutions. While markets may not make resolution, but they do offer lessons. And the lesson of 2025 is clear. Stay anchored in the fundamentals. Stay cautious when the narrative runs ahead of reality, and stay open to the possibilities that structural shifts can unlock. As we enter 2026, the task is not to predict every twist, but to position thoughtfully for cycles larger than any single quarter. Here's wishing you and your loved ones Happy New Year, happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.